been a challenging year. We had several major projects going on, planning the new exchange, Emerald, which launched this spring. Very pleased with its progress so far. Same general technology as MIAX and MIAX Pearl were built on, but with some improvements, a little faster, a little more deterministic. Members have had a very good experience so far. We just finished the rollout, so we have the same approximately 2,700 symbols in all three options exchanges now. We also launched proprietary product, Spikes. It's a volatility product to compete head-to-head with VIX. Being the second guy in, we've had the advantage of being able to change some things where there's been some challenges for VIX, and we think we've resolved those challenges, both in the settlement process, the auction, the construction of the index. It's based on SPY options instead of SPX options, and that's been recently rolled out. We worked very hard last year to build the system out to be able to trade a proprietary product. A lot of the risk protections and trade-through protections are based on NBBO, because everything we've traded up until this year has been multiply listed. Bringing in Spikes required us to take a deeper look at some of our risk protections. And before we would list the product, we wanted to make sure we had protections in place so customer market orders don't run the book, that you don't end up with bad trade prices. We've been working on an equity exchange that will be rolled out, we're hoping, first quarter of next year. That's well in the design, and coding has been started in that. It's also been an interesting year working on this conference. It's the first time we've hosted OIC for the MIAX family. It's a big project, much bigger project than people realize. There's a lot of things in the works, and certainly continuing the discussions on strikes is very important. The proliferation of strikes is problematic. And there's multiple ways to go at that problem. Are there too many classes listed? Are there too many months or expiration cycles on each class? Do we need 5 weeks of weeklies, or is the majority of the volumes in the front 3 weeks, so we only need 3 weeks of weeklies? Strike density. Somebody recently pointed out that a stock like Amazon, it's a $1,800 stock, you have $2.50 strikes. Well, $2.50 strikes on an $1,800 stock is 25-cent strikes on a $180 stock, 2.5-cent strikes on an $18 stock. Would you ever do that? Well, you wouldn't. So why do we have $2.50 strikes on an $1,800 stock? It'd be positive if we can come up with a way to mitigate some of these strikes. There's a lot of market structure discussions. Are auctions good? Are auctions bad? The other thing, there's been some really positive things happening. We've seen, it seems like a rush of IPOs of late. I think that's really good for the market. It's another place for investors to put their money. There's options already listed in a lot of these stocks, TradeWeb, Lyft, Pinterest recently went public. There's options in that. So there are more classes on which to trade options. There's a lot of interest in the public to trade these names. So I think that's a real positive. We haven't seen that in a long time. Something that would help a lot, I wish some of these companies who have allowed their stock prices to become very large numbers would split their stocks. Traditionally, a company would get to $200 or $300, they'd split their price back down. They have the Amazons and the price lines at $1,800, $2,500, $3,000. It causes problems for a number of reasons. One, a 1% move, obviously, is a big dollar number. So there's a lot of risk there in those options. There's a lot of gamma created in those options that puts the market at risk. There's a lot of people that want to buy and own these stocks and maybe write options against them, but they can't afford to buy 100 shares of a $3,000 stock. So they buy 10 shares or 20 shares. Well, they can't write options against that position. So they're completely cut out of the options market. The velocity of trade is just a lot slower in those big dollar names. If Amazon, instead of being an $1,800 stock, was a $180 stock or a $90 stock, if they did a 20 for 1, can you imagine the volume in the options in that stock?